Annual inflation has remained at historic highs, hitting 7.2% in the year ended September. Satish Ranchhod from Westpac Bank joins us now. Satish, this was not what the Reserve Bank was looking for.
No, today's result was much hotter than the Reserve Bank was expecting. We're continuing to see those inflation pressures boil over. Crucially for the Reserve Bank, we're seeing strength in those domestic inflation pressures that they've been trying to lean against.
What does this mean for your outlook for the OCR?
We've been forecasting some ongoing and large increases in the official cash rate over the coming months. Today's result cements that forecast. In fact, we think there's some risk that the cash rate may have to go higher.
Do you think that may include a 75 basis point hike next time?
The Reserve Bank did allude to the chance of a 75 basis point move at their last policy meeting. If we don't see signs that activity or inflation is easing off, that'll certainly be on the table. If they didn't go by that magnitude, we'd certainly expect to see them moving in large steps of 50 basis points at least.
Today's data would suggest they'll need to move in a large step.
There's certainly those ongoing pressures there that the Reserve Bank hasn't managed to get on top of. I think this does raise the risk that they will have to take the cash rate higher than they had previously forecast. They previously had the cash rate only peaking a little above 4%. We're already forecasting that it could hit 4.5%. What we're watching for now, though, is that with a lot of interest rates hikes already in the pipeline, that activity and inflation will begin to slow. But at this stage, it's looking like those pressures could be more persistent.
Have you changed your forecasts as a result of today?
We're going to take a look at today's number in more detail over the course of this day, and we'll then make an assessment of how things track. But at this stage, it was certainly a stronger inflation number than we were expecting, and I think there's reasons to expect some of that strength is going to continue into the new year.
Some of your economists at other banks are suggesting a OCR peak now at 5%. Is that warranted?
What it really comes down to is whether we're seeing signs that domestic activity and domestic inflation are cooling. And at this stage, I think it does look like some of those pressures are going to be more persistent. Importantly, what we're seeing is that the household sector is looking very resilient. Even though interest rates have been pushing higher for some time, spending is still holding up. We're not seeing a lot of pressure on households' finances, and that could mean that those inflation pressures continue, even given the hikes that we are expecting.
And construction costs and food prices also making an appearance, especially this month.
It's been a very widespread picture of inflation pressures. On the domestic front, construction and other housing costs are continuing to rocket away. We're also conscious that, as well as build costs, rents are rising rapidly. We're also seeing increases in food prices. The combination of food, housing, also fuel prices, that is squeezing pretty much every household's balance sheet right now.
Can you forecast where inflation might go? What are you expecting for the last 3 months of 2022?
We're expecting that inflation is going to continue at very high levels through the remainder of this year. But importantly, we think it's going to remain high over the coming year as well. We're not expecting that it's going to be back within the RBNZ's target band until mid 2024 at the earliest. And that signals a lot of pressure for the RBNZ still to lean against.
Has inflation peaked then?
We think inflation probably has peaked last quarter. That's because we saw some very large increases in oil prices as we came out of the pandemic. They're dropping out of the numbers. But even if inflation's coming down, it's not coming down very fast. We're still looking at an extended period of very large price increases.
Satish Ranchhod, thanks for joining us.
My pleasure.